A couple of things. So one, I don't think we have an inflation problem. I think it's a semantics problem. Inflation is caused by excess demand and limited supply of goods and services. That's not what we had. We had plain old, good old fashioned currency devaluation. The Fed doubled the money supply in 2020 and 2021. So an 18-month period. Look, we've been a republic for 247 years. A long time, 247 years. Half of all the dollars in the history of the republic were created in 18 months. And that causes stress.
Despite the events of the past months, the jury is still out on whether or not the U.S. economy will be able to get a soft landing in 2023. In November, while speaking at an event at Brookings Institution, Fed Chair Jerome Powell projected that there was still a path for a soft landing for the U.S. economy. The following month, American economist Heather Bushey, a member of President Joe Biden's Council of Economic Advisors, said the White House believes the U.S. economy can still nail a soft landing thanks to the large-scale government investments announced by the administration. In the same month, Fed officials estimated that the United States would be able to escape an economic contraction in 2023 narrowly. The central bankers projected that output would increase by just 0.5%, with the unemployment rate rising from 3.7% in November 2022 to 4.6% by the end of 2023. Last week, during an interview with Bloomberg, Kansas Fed President Esther George said Fed officials don't want to raise interest rates so much that policy becomes overly restrictive. She had also suggested that with that, the economy can still avoid a downturn. Here's a statement from George, who is retiring this month. This scenario, can there be a soft landing, is one we would all want to see. And there are some possibilities for that. There's still a lot of money sitting in the checking accounts of households. While some economists and top market participants believe there is a 40 to 50% chance that the Fed will be able to pull off a soft landing, others believe the economy has been in recession since mid-2022. In a recent interview with Crypto Banter, popular hedge fund manager Mark Yusko, along with Skybridge Capital's Anthony Scaramucci and PBD host Patrick Bet David, discusses his outlook for the U.S. economy in 2023 and beyond. Yusko, Scaramucci, and Bet David discussed the Fed's reckless monetary policies during the pandemic, interest rate hikes, the U.S. debt ceiling, and whether or not it's wise to invest in such an environment. Before we listen to the interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
When Jerome came into power, when he became the head of the Fed, he was Jerome, right? Buttoned up, suit and tie, the hawk, right? And he was going to raise rates. And the Trumpster just bashed him. I mean, just, no, you are Jay, the dove. And then 2020 happened, and he became the letter J, the pusher. Like, he was handing out stimmy checks at the corner of Broad and Wall like they were going out of style. I mean, he was wearing the hoodie, forget the suit and tie. He was the pusher. And then last year, somehow he shed all that and went back to being buttoned up Jerome. And he has been cranking up the heat on interest rate hikes. And everybody's like, oh, look, inflation's coming down. Because bullshit. Inflation, the CPI number, is coming down because oil prices went down, because Biden drained the SPR, and because used car prices went down, because we actually can get chips again. It has nothing, zero, to do with the Fed. The Fed didn't create the inflation. They didn't create the disinflation. It has nothing to do with Jerome. So this whole nonsense about, oh, if we can get a good CPI print, then the market's going to moon. Bullshit. Look, the Fed going from 75 to 50 basis points is not a pivot, right? Oh, he pivoted. No, he's still raising rates. He's still limiting liquidity. He's still tightening monetary conditions. And the market's calling bullshit, right? The market is pricing in cuts this year. I think they're going to be sorely disappointed, because he is back to doing what he thinks is his job, which is short-term interest rates for 200 years have roughly equaled nominal GDP growth. Nominal GDP growth is probably around 4%, and short-term rates need to stay at 4%. They're not going back to zero. They're not. And so everyone thinks, well, we're going to get this big boom in the market. Well, has anyone seen earnings lately? They're not good.
At 2.9% GDP growth, that's not a recession. That's nowhere near a recession.
No, it is. No, it is. Rand, no, absolutely not. Okay, first of all, that 2.9% is meaningless. Q3 and Q4 GDP are totally meaningless numbers because 3/4 of it is the release of the SPR. We're double counting the oil again. So that's the first thing. The second thing is the year-over-year change in GDP was 1%. 1% is a recession. Full on, that is a recession. It's the same as 2001. And we're reliving 2000 and 2002. Last year was 2001. I think this year will be 2002. And all the fraud's going to bubble up to the top. All the cooking of the books in corporate America is going to bubble to the top. And I don't know that we'll have an Enron.
I don't see how they wait for inflation to go back to 2%. You look at the debt level and you look at the interest rates. Let's just go over this for everybody. 38% of the national debt is rolling in the next 2 years. So let's say 40%, just to round it off. You see the debt clock. Let's call it 30 trillion, just for simple mathematics. That's $12 trillion of debt. That's picking up 200 to 250 basis points of interest rate expenses. Okay. So let's do the math together. That's $240 million, billion dollars of additional interest rate. Meant to say billion. You get them all confused. I think that's one of the problems, Mark. These congressmen really don't know the difference between trillion, billion, and million. There's no Fed person looking at that and saying, okay, no problem. Let me jack rates another 300 basis points because I don't like this last inflation print. You know, and Barry Sternlicht said it the other day, you know, Volcker didn't have a $32 trillion debt balance sheet. So I don't know what these guys are thinking. You're going to have a $1 trillion interest expense on the federal budget. How are you going to do that, guys? You're not going to be able to do that. You're going to monetize the debt, whether you like it or not. They're going to bring the rates down. It's going to pop the market.
During the interview, American entrepreneur and financial advisor Patrick Bet-David, who hosts the PBE podcast, discusses the impact of the fake pumping of the economy during the pandemic. He explains that low-income earners are the most affected by the policies, which, ironically, were implemented to support them. Bet-David also discusses the U.S. unemployment rate and the importance of dollar cost averaging despite the harsh economic conditions. According to the famous podcaster, no one knows for certain what will happen in the coming months, but it's never a good idea to stop investing.
So in bodybuilding, when a bodybuilder does steroids, so the body stops producing testosterone, right? And the body gets like, let's just, you can take your levels from 400 to 1200, like you were 18 years old, and look at the muscles I'm building. Look how cut up I am. I'm taking all these steroids. Your body stops producing naturally. So when we went on a 128-month economic expansion or 129 months, oh my God, look how much money we're making. This is the first time we have all these people worth $100 billion. Look at the kind of wealth that's being created. This is amazing. You know, all this fake success. A lot of people had a lot of fake success. And then, boom, people got exposed. Boom. 50% that Mark was talking about in 18 months, which is insane. Oh, this is going to help low and middle income family. Low and middle income family would have money if they knew how to save. So the money rolled up to the rich. The rich got richer. So the same people that wanted to help the poor and low and middle income, they hurt them. They made the rich richer. And that's a left-leaning policy, by the way. That's not a conservative policy, but the reality is both of them spend the money. Trump was worried whether he's going to get reelected. So let's spend the money ourselves. Then, you know, Biden does the $1.9 trillion on March of 2021. And the next month, everybody's bragging about the fact that, did you see what happened with the savings rate in America at 27%? It's unbelievable. The American people are saving money. This is the model. But then look at the numbers today. Last month's savings rate is 2.4%, lowest in 17 years. Everybody's talking about interest rates and everybody's talking about inflation. No one's talking about unemployment. I mean, if you're going to keep these rates going like this, what's going to happen Q3 of 2023? Well, we're estimating that unemployment could go, you know, around 4.5 to 5%. We don't know yet. We're seeing what's going on in the technology sector. We saw what Goldman Sachs came out in the article talking about 4 markets that are going to hit real estate that are going to lose more than 25%. San Diego, San Jose, Austin, and you have Phoenix. And what do those four things have in common? San Jose, tech. Austin, tech. You got Phoenix, semi-tech. The only one that's not tech is San Diego. San Diego's got a different kind of a sector they're dealing with. We're expecting these four markets in real estate to dip 25%. So, okay, where is this going? We're going to get more layoffs. We're seeing Amazon. We're seeing Google. We're seeing all these Microsoft. Here's how they sent the email to. Now we're seeing Redfin. Now we're seeing Spotify. Now we're seeing all these other guys. We don't yet know what's going to really be happening. So we can sit there and be very optimistic this year. It's not recession. It's really 2.9% or 2.4%. And the market saying, no, it's really 1%. If you take the oil out, which our reserves kind of depleted, it's probably the worst time ever to be an expert. Okay. It's probably the worst time ever to act like you know what's going to happen, because none of us know what's going to be happening. So the question you asked at the beginning, where you said, today we want to talk about, is it the time to buy? Is it a time to get back into the market? Is it a time to deploy some of your money? I think you could do that and come out looking smart a year and a half from now. And you can do that, look like an idiot 6 months from now. But we ought to do that. I mean, the reality of it is, unless you can predict the future, we have to kind of go back to the same old boring philosophy of dollar cost averaging. If you're going to go in, whatever the amount is, maybe start 5-10%, 5-10%, 5-10%, 5-10% gradually, without assuming that we all know what's going to be happening. Because the reality of it is, when you look at all these numbers that we're all talking about, no one for a fact knows what's going to happen, because you don't control the pen. Powell does. We don't know regulation with what they're going to be doing at the top of the U.S. government.
Bet David and Scaramucci also discussed the cluelessness of the global elite about the cryptocurrency market. This cluelessness has been perfectly exemplified by JP Morgan Chase chief executive Jamie Dimon in recent months. Despite the bank's significant involvement in the cryptocurrency industry, Dimon has continuously shown a lot of skepticism toward Bitcoin and the overall crypto market. Last week, he called Bitcoin a hyped-up fraud and a pet rock. Dimon also showed a lot of ignorance regarding Bitcoin's 21 million supply cap. He said, "How do you know it's going to stop at 21 million? Maybe it's going to get to 21 million and Satoshi's picture is going to come up and laugh at you all. And by then, Satoshi would have taken out billions of dollars." Scaramucci noted that the Davos elites who said many negative things about crypto last week are as wrong as they were when they predicted a massive economic decline in 2009, just before the beginning of the biggest bull market in U.S. history. They also wrongfully predicted that Hillary Clinton would have a landslide victory in 2016 and Donald Trump would be reelected in 2020. In fact, the Skybridge Capital founder says their bearish remarks are an indicator to go all in on crypto assets. What are your thoughts on our outlook on the U.S. economy? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and check out our other videos. Thanks for watching.